is going to give us some insight and let us know what options that we have for those who are in this state and have equity that they're trying to get to and use for whatever purpose that you need to use it for. So, Dory, welcome. I
Thank you.
appreciate you
Thank you.
attending. Yes.
Yeah. So a couple things in the state of Texas for cash out. You are correct. It's its own state with its own rules. The max CLTV you can do in Texas is 80% for cash out, and we are able to do that on both HELOCs and fixed rate home equity loans. So that's an important thing to know. We can do both product lines, and I'll kind of go over the differences in those.
Okay.
And we can only do those in Texas on primary residences only. And the max total fees that you can charge in Texas is 2%. So I can kind of touch on that a little bit too. So there are some unique things in Texas.
Yeah.
I think one of your questions is you wanted to kind of know the differences between the two products.
Yes, ma'am. So you could you explain to the people, what's the difference between a HELOC and a HELOAN?
Okay, so the HELOC is the 10-year interest only payment with a 20-year repayment period. The reason why people love that one because it's an interest only payment for the first 10 years. But it is an ARM and it is based on Wall Street Prime. So that could go up or down each month if something does change with Wall Street Prime. So Prime did go up again a week and a half ago to 8.25. So yes, it's a little daunting for people right now, but again, people still love it because it is an IO payment. So the floor on those are 4% and the ceiling is 18%. And if you think
Okay.
about that, the ceiling is actually lower than on most of these credit cards that are out there right now. So even if something, weird happened that it did go up to 18, it's probably going to be cheaper than some of the credit cards that people have, honestly.
Oh, right. So let me
The
explain to the
other,
people what the floor and ceiling is. The floor is how low, basically the lowest interest
the
that you would
lowest it could
charge.
go. Yes.
Right.
Yep.
And the ceiling is the max that you can
The highest it
charge
got.
on the interest. Okay.
Yep. The fixed rate home equity loan, which is becoming very popular right now, is a close-ended fixed rate. So you get all the money up front and you pay a P&I payment through the term of the loan. So the payment does not change up to 30 years. So that's become very popular now because people want that consistency, right? They want to make
Right.
sure their payments aren't going to go up or down. So that's a very popular product right now. So that's kind of the main differences. And people always say, well, why would I go with one or the other? I mean, it's really going to be about the comfortable about what the borrower wants to do. I mean, and if it's a short-term loan, I always say if they plan on keeping it for maybe a couple of years, maybe the IO payments can be the best thing for them, right? Because its payments can be maybe cheaper, lower than if you did a P&I payment. So I like the fact that we can offer both product lines to our borrowers. You don't have to go to one place, one lender because they only do HELOCs and another because they only do fixed rates. We offer both product lines, so which is great. And
Okay.
as far as I think your next question was eligibility requirements, I
Yes,
mean,
ma'am.
obviously we need to, you're going to take a full application. We have FICO requirements. The HELOCs, we can go down to 660 minimum, and the fixed rates, we go down to 640 minimum FICO scores.
Yes.
We do go up to, in other states, we do go up to 95%, but Texas, again, we're maxed at
You matched
80%
that
capped out.
80%
80,
capped
80,
out.
yes. So that's another thing to keep in mind. Obviously, we have debt ratio requirements. We do require full documentation for 2 years. So if they're
Okay.
self-employed, we will need that 2-year tax returns. If they're W-2, we will need those 2-year W-2s, 30-day pay stubs, same documentation you would need on a first mortgage.
For, okay.
Okay?
So on the standard conventional, whatever you just basically for qualifying, this is a non-QM product, but to qualify for you need full documents.
Yeah,
Is that
we're
correct?
actually when you do a second mortgage, the HELOC is considered a non-QM loan, but a fixed rate is not considered non-QM because we follow TRID when it's a fixed rate. So
Okay.
you still have the same rules that you have to follow just like you would on a first mortgage. Then you do also need to follow some other rules as far as appraisals go with fixed rates, considering if it's not QM. And that's more of the difference between the APR and the OPR spread, if it's considered not QM in the fixed rates. And those are all determined prior to disclosures going out if it fills into that.
Okay.
So we don't really know that always upfront if we need a full appraisal on those fixed rates.
Hmm. Okay.
And then
Is it
you
just
were
one appraisal? That's the part?
Yes.
Okay.
Yep. Run appraisal. Now, it depending on what the product is. For example, if it's under 250 loan amount, we're doing a HELOC. we always first try to run an AVM. If we don't get the AVM hit, it'll be a drive-by appraisal. Over 250, we always need full interior appraisals.
Okay.
And we take care of ordering all that. We take care of ordering the title work, so you don't have to worry about that. We take care of whatever the appraisal needs. We send out disclosures. We just need you to get an application into the system and then you upload docs for underwriting. We take care of the rest. So we try to make it
Gotcha.
as easy as
As
possible.
easy as possible. Okay. Good deal.
So like I said, you asked what are your upfront fees? Only fee you ever have to pay up front is if I need a full appraisal. It's the only
Okay.
fee.
If you
So,
so
and also,
the appraisal
what?
would be the only, if you do need anything up front, it would just be the appraisal. That's basically what you're
That's
saying.
it.
Okay.
Everything
Okay.
comes out of the proceeds. Any type of fees, your compensation, anything comes out of the proceeds, which is
At
nice.
closing. Okay.
At closing, yep.
Okay.
And as far as like how are rates calculated, I mean, it's going to be based on FICO, CLTV, debt ratio, all that good stuff. So it's what I always tell people. So we do not use your tri-merge. We pull the Experian 8 version, which is the
Yeah, I was
consumer
going to ask you
version.
about that. That's the first that I've heard or
Yeah, it's
yeah.
actually usually more forgiving, but not always. And so, what I always suggest people to do is have them do the Experian Boost ahead of time. It's free, it's instant, and that's the score that we use. So they simply go to experianboost.com. There's a little button that says Start Your Boost. And
Mhm.
what it's doing is it scans for everything they pay positively for, like utility bills and streaming services, and it boosts the score. And that's the one we use. So, a lot of people, don't spend the money to pull a tri-merge. Maybe if you want to pull one soft pull, just to make sure our ratios are in line ahead of time. But other than that, I mean, I would not spend money for a tri-merge. So it doesn't
Okay.
make sense when you're sending it to me because we don't use that credit at all. But the Experience Boost is great because you'll know ahead of time. It's free and it's instant. So, and it takes 5 minutes to do it. So it's really easy to do.
Okay. So does this particular since there is a second basically a second mortgage on the property, and this type of mortgage, if I understand it correctly, is going to be in the second lien position. And how does that affect the existing mortgage, or does it affect it at
It
all?
doesn't. Yeah, it doesn't. So we don't touch the first mortgage. We're simply in second lien position. There's no subordination needed. People think that all the time. No, it's just keep that in place. We just go behind the first as a second lien position. We can also, though, in Texas, be in first lien position. So let's say they own their primary residence free and clear. We can be in first lien position as a HELOC in Texas to do that.
Okay, so that must be the exception that you're speaking of. You have to have your home free and clear of any mortgage in the state in order to do a HELOC.
Yeah, if
Is
you
that
own your home free and clear, which a lot of people do, we have to
okay?
do it only on the HELOC program. I can't be in first lien position on the fixed rates, only the HELOCs.
Okay,
And
okay.
Texas is allowed to do that. Not every state's allowed to do that, but Texas, we're good with that. Now,
So you
one thing,
mentioned. No, I'm sorry. Go ahead.
one thing I was going to say too for Texas, we cannot be behind another A6 loan, another cash out. So if they did a cash out, 3 years ago, we can't be behind that. That would have to be refinanced
Got
as a
you.
rate and term, then we would be able to do it. But so that does pop up sometimes. So that might be one of the questions you ask when you take an application in Texas. Was it a purchase money? What are we behind right now? Because we can't be behind another cash out. So that's a great question to ask.
Okay. So if they took. So let me make sure I'm clear. If their current mortgage was a result of a cash out refinance, they would have to actually do another mortgage in order to do a
They'd have to
HELOC
refinance out of that as
refinance
a rate and term,
rate and
and then
term
there's a
with no
waiting
cash
period,
out.
and then we could do it. Yeah.
Okay.
So Texas is strict, and also, every lender has their own way of interpreting some of these laws, and that's how we interpret it. So we just can't be behind another A6. So that's one of your first questions you should ask.
Okay. Definitely gonna ask that question. Okay. So let's just say, can they pay this off early? Like, what are there any prepayment penalties for this type of loan?
There's no prepays. We just want to make sure the line's not completely closed or paid off the loan within the first 6 months due to EPO. The
Okay.
other thing we don't want is that if someone's taking a HELOC out, let's say they take a line out for 100, initial draw 50, and then they want to turn around and pay it down right away. No movement on the line for the first 90 days. We're selling the loan to the investor based on how we close the loan. So it's very important that your borrowers know that. No movement. So after 90 days, they can pay it down. Whatever they want to do with the line, just don't close it within the first 6 months due to EPL. Meaning
Okay.
you would have to pay back our commissions. We don't want that.
Okay. So, say let's say I'm in the market. Let's say I have some equity that I want to pull out. And with the way houses are going up right now, a lot of people do have equity in their home that they're trying to make get used, get their hands on.
Absolutely.
When I'm looking for a lender to do this type of loan, what are some of the key things that I should look for?
Well, I mean, for us, I mean, what makes set us apart, like I said, is that we're offering, the two product lines that makes us special. We're actually a little more aggressive as far as what we are going to allow for debt ratios. I mean, yes, you're in Texas, but I know you're in other states too. We go up to 95% CLTV. That's pretty much not unheard of, right?
Right.
This product can be used in most states, not in Texas, as a piggyback for purchase and refi, which a lot of people don't do. They only do maybe only piggybacks or just standalone. We do both product lines.
Okay.
So we're just unique in the way that we're kind of like outside of the box doing unique stuff. Now we are full doc only, but we're a one-stop shop for your second mortgage needs. I mean, 90% of the people already have their first mortgage rate that's extremely low. They don't want to touch it. So we're going to be that shop for you that you're going to be able to put your loan through to help your borrowers. Don't send them to a credit union. Don't refer them out. Keep your borrowers for you. And
Right.
because down the road, you're probably going to refinance the first and the second together someday as one, right?
Right. Right.
So you never want to refer your borrowers away. Keep them for you, long-term customers. And now a lot of people go, "Oh, I'm not making that much money." To me, it's better to do it, keep it for yourself than refer because you think you're not making that much money on a second mortgage. Because that borrower could then go to that new credit union you just refer to, and they're never going to come back to you again. So,
Okay.
yeah, I definitely believe in that.
So with this type of loan and actually having a second mortgage, I know one of the biggest concerns for a consumer borrower is the debt to income, because you're taking both, right? You
Especially
still have
now.
your first, yeah, you still have your first mortgage, and now you're getting the second mortgage. Um, are they paying PITIA again, or I mean, how is that structured on the
Well,
second?
debt ratio is, I mean, you're right. We have to follow debt ratio rules. And when it comes to the HELOC, it is kind of hard because you have to qualify a borrower 2% above whatever the initial start rate is because it's an arm, right? So if something would happen with rates, we got to make sure they can handle a higher payment. So we
What
can
about the HELOAN?
absolutely pay off debt to get ratios in line. That's the number one thing we do. Debt consolidation loans. A lot of
Okay, so
people.
so you're saying that, okay, so let's say on a HELOAN or HELOC, but let's say in particular a HELOAN, right? Um, the funds that I may be receiving at closing, uh, to actually, and that's information for me as a mortgage broker. I can use those funds to say a trade line is going to be paid off on the credit report.
Absolutely. Yep, absolutely. That's another thing that a lot of lenders are not allowing is to pay off credit cards in the term, but like in the middle of the loan. So that's one of the biggest things we want is the debt consolidation. And they do not, if it's a credit card, we do not actually require them to close it either. We're just going to make
Okay,
sure it's paid off in
paid off.
full through closing. Yes.
Okay, paid down to a zero balance.
Yep, exactly.
Okay, that's good to know. I mean, why wouldn't they do that anyway? But this way for sure
Exactly.
that it's paid down.
Yep.
Okay, let's see. So what are the risks? What are the downsides to considering a second equity loan,
Well, I
standalone
don't
type?
think I don't think there's any downside to it. I think that, I think it's the positive is that the fact that people are so blessed to have equity in their home to be able to utilize it, right? So
Right,
why not take it out to do home improvements, debt consolidation? Maybe just have money in a little nest egg in your account to feel comfortable, just in case. Maybe they have to pay for their children's education. I don't think there's anything bad about it at all. I think it's a positive thing, especially in Texas. If you think about it, they protect you, making sure the max you can even go is 80%.
right,
There's no loss there. It's pretty phenomenal that they actually have that law. I mean, it's too bad they can't go up to 95, but it's probably a smart thing because they were the ones that had issues when the housing market crashed, right? So
right.
because they were protected at that 80% max, where people were going 100%, 115 CLTV on their home values.
Right.
So
So that is a good protection for some
yeah, it
people.
is. I agree. Yes, but no, I at this time right now, I don't think. I mean, do I think that's why we are somewhat not strict, but we have guidelines around debt ratio. We're not going to just do loans for someone that can't afford the loan, right? You got to be able to
Right.
show you can afford the payment on the loan.
Yeah,
So
the
that'd be the only
ability to
thing.
pay.
Yes, that's the only thing would be a concern is someone, doesn't, can't afford the payment. Back in the day, people were doing stated loans. I mean, we're full doc. We know this person can handle the payment. They can afford this payment, and we're not going to have any issues with non-payment in the future, which we don't, by
Okay.
the way.
So it sounded like to me that the prime candidate for this type of loan is someone that already has, even with their current mortgage, has a low DTI.
Well, it definitely helps, and
Yeah.
for sure. But we do go up, like I said, we'll go up to 50% debt ratio. With that 50% debt ratio to go over 45, you do need to have a 700 FICO score, and you need $3,500 in residual income to do that. So
Okay.
we make sure that they're protected, that they have that little nest egg. So when I say
Okay.
$3,500, meaning you take their gross income, subtract out all debts, that net number has to be $3,500. So we're
Okay.
not going to put someone in a scenario that they can't afford it,
They can't
right?
afford it. Right.
Right. So
Okay.
that's why we
So
have those things in place.
so how low can you go on a loan? Let's just say I got equity. Let's say I just want to get, I don't know, $20,000 out of that. I mean, is that possible?
We are so 25,000 on the fixed rates, $50,000 minimum on the HELOCs.
Okay. 25 on the fixed rate on the HELOC.
50 on the HELOC.
I think you mentioned IO. You have an interest only. You say you had an interest only option
Interest only is for the HELOC.
for the
That's what the
HELOC up to
HELOC
10
is.
years.
It's
Is
a 10-year
what you
interest
mentioned?
only payment, and then it's a 20-year payment. So the line closes after 10 years, then you pay a consistent P&I payment through the next 20 years to pay it off.
Okay. Okay. And are there any circumstances under which you as the lender can change any terms or can call the loan in or change the terms at all, or is this
Well, I mean, not for a fixed rate. For HELOCs, I mean, we all know anything can happen. If they, let's say, like it happened to me back in the day, right? When home values went down, there's nothing in that says that they can't take your line away if you didn't use it. I mean, I didn't use our
okay?
line. There's nothing. Any lender could do that, you know. So as far as a fixed rate, though, that's a little different because you actually got the money
You
already, so
locked
you're
in,
paying a P&I
right?
payment.
So you're just
Yeah.
paying in the back.
But
Okay.
HELOCs, I mean, sure, they could. I mean, who knows what could happen? It happened to us. So, but
Right.
I've been here for over 4 years and I've never seen anything like that. So, we don't know what's going to happen in the future. Let's just hope it's nothing like
Right.
that, right?
Good deal. Good deal. So okay, so I got to let's just say I got a borrower. They're ready to go. Documentation, full documents. I got everything. Um, how long does it take to close once you get all the documentation that you need?
So we're about, as of today, we're about 21 days averaging right now from start to finish. So our goal is to get it down to 2 weeks. It's really about how quickly you get docs uploaded for underwriting, right? What is the appraisal that we need? If we need a full appraisal, is the job being picked up quickly? If it's a drive-by, those average like 5 to 7 days. So all that together depends. But of course, I've had some done shorter and some longer. Is it a complicated file? Does it have to go back to underwriting 4 times? Those kind of things. But averaging today, we're 21 days, which is awesome.
Okay, great. Dory, I sure appreciate all the nuggets
Yes,
and
of
the
course.
information about this loan. Being in this state, I'm curious. I actually get a lot of questions about, you'd be surprised how many people are trying to do HELOCs in the state and they feel like they're stuck, that they
Yes,
don't have
I
an
know.
option.
I get it. Well, I am
Yeah,
here to help you, my friends.
definitely. So, in conclusion, is there any other insights or any other things that that people should be considering before taking up this loan, or just any other information you want to just leave us with?
You know what? Just everyone look at their own circumstances, see is it the right for them to get a second mortgage? I mean, right now people are wanting to do home improvements. People are wanting to do debt consolidation. All those things are important for people right now. And people want to tap into their equity. I mean, they should be able to do that. So obviously, a Spring EQ is going to be able to give you the tools and the resources to do that for your borrowers. So you're good.
Okay. Okay.